value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia. Welcome back to the show, Victor.
Well, thank you, Jim.
Victor, we're less than 2 weeks away from the U.S. election, with some commentators forecasting a Democratic Party sweep of the White House and Congress, while other commentators say this is just like 2016, when Hillary Clinton had a big lead in the polls, but Trump became president anyway. How is this uncertainty playing out in the markets, and is politics having a bigger impact on the markets now than ever before, or does it just seem that way?
Well, I'll tell you what, it's not just that it seems that way, it really is that way. Politics in one way or another has always had an impact on our markets, but I think that really kicked into high gear when Trump became the president. With all of his tweeting, constantly referring to the stock market as though, he personally was responsible for the stock market making new highs. He didn't usually tweet out if it was going down. Then we had those, remember the trade talks or the tariffs. There'd be a tweet come out that something is going to happen. So, the market became very focused on paying attention to what was going on in the political scene. I think, to be fair, during that time, say 2016, 2017, when Trump was really starting to be noticed on a regular basis, the central bank impact on the market was less than it had been previously, when in many ways it was all about what the central banks were doing. And then, of course, this year, when the virus hit and we had the subsequent government and central bank response to the virus, the lockdowns, the stimulus in different ways and that sort of thing, that was really the only thing that mattered. I remember at one point we had the monthly unemployment data would come out at 5:30 in the morning Vancouver time, first Friday of the month. And I grew up, not quite 50 years, but certainly well more than 40 years in the brokerage business. I grew up with being aware that at 5:30 in the morning of the first Friday of every month, the markets could rocket one way or the other because of how the unemployment report was. It was the granddaddy of all economic data. Well, here, I don't know if it was the beginning of September or the beginning of October, the unemployment report came out and it was just a total non-event. Didn't matter. I have all kinds of schedules that I look at as to what, economic events are coming up and what markets are expecting them to be and all that kind of thing, so that if the market will react if the actual report is much different than expectations, and all that stuff just doesn't matter here the past several months. The only thing it seemed that mattered was, whether or not lately the Treasury Secretary was going to be talking to Pelosi, and maybe she'd hang up on him or not, or maybe they're going to do a deal or not, and the market would ebb and flow on that. So it's been, honestly, a bit of a gong show as to how much politics has impacted markets, but it's just the way it is. We're less than 2 weeks away from the election. I have seen all kinds of analysts saying, okay, if you expect, the election to go this way, then, here's the portfolio you want. If you expect the election results to go this other way, then you want, own these stocks and don't own those ones. We're seeing some of that, I think, already. I think the market really is pricing in a Biden win. All the polls were pointing that, or I should say all the polls. A lot of the polls were pointing that way. But when you see, for instance, baskets of what we would call green stocks doing very well, that would be perhaps on an expectation of a Biden win, that sort of thing. So, yeah, politics having a big impact on markets more than ever before, and certainly going into the election, that could be huge. When Trump was elected, I remember that evening in the overnight Dow Jones market, it dropped 1,000 points and then recovered all of that by the next day. So, yeah, the election's going to have a big impact on the market, and perhaps for the cognoscenti out there, the really important thing is going to be how the Senate goes. But let's not get into being political analysts. Let's just stay with the market.
When we talked about a month ago, you were very focused on what you called a key turn date around the beginning of September, when a number of markets, but particularly the major American stock indices and the U.S. dollar, all seem to abruptly change direction and go the other way. Well, let's talk about the stock market first. What happened in early September, and do you think the huge rally we've seen since March is due for a correction?
Okay, in the first week of September, so call it 6 weeks ago, the S&P major index, the NASDAQ 100 index, the Vanguard Total Market Index, these are just three very broadly followed indices, all made new all-time highs. Point out that at the same time, the Dow Jones, that we all look at, the industrial index, did not make a new all-time high, nor did the Russell broader market index, nor, by the way, did the Toronto market. But leading up to that, it's maybe much more important. And we obviously, you go back to February markets, those same things, the S&P, the NASDAQ, Vanguard were at all-time highs. The virus came along. We had this very sharp fall into the March lows. I think I've read somewhere that it may have been the fastest break we'd had in a market ever, although, I don't know, I remember in 1887, and that all happened in a day, so whatever. We had this very sharp fall into the March lows, then massive stimulus from central banks and governments around the world, and the market started to rally throughout the spring, the summer. I think we had, in a way, a blow-off top in August. Sometimes over the years we'll refer to the trading in the summer as the silly summer season, because in effect, the adults have left the room and the kids are on the trading desk to just kind of, look after things while the adults are on vacation. We had maybe a poster child for what I'm talking about in terms of a blow-off top in late August. Both Apple and Tesla announced, I should say, share splits, partway through August, and both of those companies' split shares were going to start trading on the very last day of August. And, if you did a normal cost-benefit analysis, you'd say there shouldn't be any change in the market cap, just from that. But there was a huge change in the market cap, as a lot of the millions of new retail buyers that we have in the markets these days came in and bought those shares on the anticipation that the shares would go up because of the share split. I think another poster child for the end of August period there was massive option buying. We saw the put-call ratio, for instance, the number of calls relative to the number of puts that were bought was way skewed toward call buying. And the buying was particularly in very short dates with out-of-the-money options. The guys on the floor, I think I mentioned this before, would refer to that kind of option buying as lottery tickets. Like your chances of getting rich are about the same as a lottery ticket, but if your number comes up, it's going to be a home run. So we had this very aggressive, I think, risk-on mood going into through the end of the summer period. We made new all-time highs in a couple of those indices, and I think my take on it was we just blew it out to the upside. There was also talk of an all-one market out there, and that was essentially stocks and commodities were going up, the U.S. dollar was going down, and interest rates were just out of the picture. They were flat. Nobody cared. So that risk blew out. We had a correction of about 10% in the broad indices into the September lows, and then the market rallied back here, but didn't make new highs. So the high was maybe 2 weeks ago. what I'm looking at here is I think we had a top, an important top, around the beginning of September. We had an initial sell-off of about 10%. Markets rallied back. Hasn't made new highs. I'm thinking there's a possibility that it rolls over from here. One of my classic favorite chart patterns is this sort of a double top where the right shoulder is lower than the left shoulder. That's kind of the way I'm playing it. There was also, without getting too technical here, I think quite a rotation within the stock market. In other words, people were shying away from things like Apple and Tesla and buying some other things. I got to point out on the basis of that, you take the Dow Jones Transports, for instance, has been making new all-time highs, while the other markets have been definitely lower than that. And a stock just as simple as FedEx. FedEx has been on a hell of a tear. It's making new all-time highs as well, while, Apple, Microsoft, Amazon, that sort of thing are not. So, I think that's kind of what's happened, and my view here is I'm bearish here, always cautiously, because, I'm often wrong, but I think we may have had a double top in the market. And if the market does start to drift a little lower, you'll see the market, I think, will be focusing more on some of the negative news that's out there. We still have millions of people unemployed. Lots of businesses have failed. The virus continues to spread, that sort of thing. That'll be in the news.
The U.S. dollar index hit a 28-month low around the beginning of September, then turned higher against nearly all currencies. You thought that the major stock indices and the U.S. dollar all reversing direction around the same time was significant. Why is that significant? What's been happening to the dollar, and where does it go from here?
If one market changes direction, it's been trending up and then stops and starts going the other way, that's one thing. But if a number of markets all change trend on or around the same date, then I think that makes it a lot more important. There wasn't really, that I can remember, any major political or economic news that happened around the first day or two or three of trading days of September. I really think it was just this topping out of this sort of giddy risk on, buy anything that's not nailed down attitude that was happening in late August, and we had an extended blow off top there, and a top not just in the market but in sentiment, in the risk on sentiment that caused people to go out and buy things like that. So when the market started to turn from this giddy risk on view to something different, maybe a more risk-off, risk-averse thing. When the psychology changes like that, capital will flow to safety, sometimes faster, sometimes slower. At that point in time, the U.S. dollar was at what we're saying, about a 28-month low, so the U.S. dollar looked cheap. I mean, the Canadian dollar, for instance, got down to 68 cents when everything was freaking out in March. That was a 4-year low on Canada. So Canada, by the time we went from March to September, Canada had rallied all the way up to 77 cents. The euro currency, 107 in the March lows, 120 at the beginning of September. That was a 10%, pardon me, I should say a 12% gain in euro. So the U.S. dollar looked cheap at that time, and I think that one of the reasons that people said, okay, sold to you on the Canada, sold to you on the euro, and went into the U.S. dollar. The U.S. dollar rallied for most of September. I mean, not a huge rally, but rallied off the lows. But then it's turned down here again in late September. And actually, I've been inclined to think that the U.S. dollar was going to do better. I got to be. I've been actually stopped out of some of my positions there with some small losses. So at the moment, I'm neutral on the currencies, looking at them, but thinking that the U.S. dollar maybe does better. And I can't leave this part of the discussion without pointing out that the currency markets are not monolithic, and there has been certainly one currency that sticks out here like a sore thumb, and that's the Chinese renminbi. It's at a 2-year high against the U.S. dollar. I think one of the reasons for that is the interest rate spread. You basically get nothing for interest rate premiums in U.S. dollar instruments. You're going to get a 2% premium to be in the renminbi. The People's Bank of China has not been printing money, like crazy, like has been happening in the United States and basically the rest of the Western world. And it also seems as though the Chinese economy has recovered from the virus that hit over there, and their economy is back, let's say, much stronger than the recovery that we've seen out in the West. So that currency's done much better than the U.S. dollar. British pound, I mean, you can't think of anything but Brexit when you look at the British pound, and if you know what's going to happen to Brexit, you can make a fortune trading the British pound, but I have no idea. Oh, one last thing, I guess. The analysts that I talk about that say, a portfolio if Biden wins, a portfolio if Trump wins, the analysts who say if you think Biden is going to win, then they're projecting a weaker U.S. dollar.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Victor Adair. Victor, gold rallied about $600 from its March low to new all-time highs in early August, just over $2,000. Over the past couple of weeks, it's on either side of $1,900 an ounce. What's been driving gold, and what do you think is going to keep going on?
Well, the gold market over the past 2 years or so, I think it's been very highly correlated with real interest rates. This is nothing new, as real interest rates have been falling during that period of time. Okay, when I say past 2 years, go back to the fall of 2018. Gold has been rallying. During that time, real interest rates have been falling. Real interest rates, simply, you take the interest rate on a bond, subtract out the implied inflation rate, and you get real interest rates. It used to be over on historical chunks of time that the price of gold was very negatively correlated with the U.S. dollar. The U.S. dollar was strong, gold was weak, and vice versa. That impact from the dollar seems to be less over the past 2 years, although on short-term swings here the past few weeks or so, I think we're starting to see the gold market just move opposite of the U.S. dollar a bit. The thing that's really given the boost to the gold price this year has been relatively massive buying of gold ETFs, primarily in America, some degree in Europe, and at the margin, the rest of the world. But basically, it's the United States gold ETFs and some help from European ones there. So far, year to date, the gold ETFs have bought about 1,000 tons of gold. That's a lot. Yeah. And that is more than made up for the lack of buying that we've seen from traditional retail markets in India and China. Now, roughly speaking, India and China retail demand is down maybe 50% this year from what it's been the last couple of years. Just order of magnitude, don't hold me to the hard numbers. So this ETF buying has been, in my view anyway, the powerful force that helped run the price of gold up $600 from those March lows to the highs we had in August. You can see this in the reports as to, like from the World Gold Council, as to how much buying has been done, week by week by week in the ETF market. The gold futures market, not as important, I think, as it used to be. We lost a lot of open interest in the futures markets. back in the March, April period when with the virus was hampering the physical transportation of gold for arbitraging the COMEX market. So I think the net out of that is the ETF market in a way took over from the futures market in terms of retail buying of gold. I think another thing here is in the futures market, people can get in there, and if they get aggressive, they can be in there and buying a lot more gold than they can really afford, perhaps. A lot of leverage available in the futures market, much less leverage available in the ETF market, which might mean that the buyers of that market are going to be stickier than if they were in the futures markets. In other words, the price backs up $50 or something, they're not going to, have a panic attack and sell out their position. So, where do we go with that? Where does gold go from here? I think it's been kind of in a narrow range and a narrowing range of the past 6 weeks or so, kind of directionless in a way. This wedge pattern that it's created, I think it'll have a breakout one way or the other. I'm kind of neutral as to whether it goes up or goes down at the point. I mean, I know the gold story says when you print all this money, then the price of gold has to go up. Well, okay. I mean, there's nobody in the gold trading business that hasn't heard that story, and it's old. So here we are. It probably takes something new to give gold a kick one way or the other.
When we've talked about crude the last few months, you kept saying it's a lack of demand market. WTI seems to have traded around $40 the last couple of months. What's happening with crude, and what would it take to get prices to go up again?
What would it take? I mean, well, let's stick with that. In my view, it has been a lack of demand story, and particularly transportation fuel. And if you want to get even more particular, especially jet fuel. I mean, planes just aren't flying anywhere near as much as they were. End of story. You got slower economies equals less demand. People staying working from home, they call it, and not driving. You go out and look at the freeway. There's less traffic. So that's on the demand side. On the production side, you got countries that produce oil that need revenue, and if it's $40 or $80, they still need to pump oil to get some cash flow. So it seems as though the supply-demand equilibrium lately has found a number at around $40 on WTI. What would it take to get oil prices to go higher again? If we had some bottleneck of some kind in production, certainly that would do it. But if anything, it looks like there's lots of production that could probably come on stream pretty fast. And the OPEC plus their friends seem to be trying to agree amongst themselves to rein in production so that they don't drive the price down to $20 or something. But on the demand side, I mean, if you get the economy going again, I mean, if somebody comes up, if we have a vaccine, the vaccine's just magic, right? Although that looks further into the distance every day. But if we got people flying in jets again, and the jet fuel is being used, and people were driving cars to get to work and that sort of thing, get it, that would get us higher again. So I think we're a little stuck here. And if anything, if I've got a little bit of a bearish view on the stock market. I just think there's been a lot of whistling past the graveyard buying stocks because there's been so much stimulus. And if we get more and more stimulus, that should boost stocks further in the future. But with a lot of businesses, I think, let's call it forbearance. There's that term where, if you owed money to the bank, they kind of give you a little pass for a while. But sooner or later, they're going to want to get paid. The landlord's going to want to have the rent paid and so on. And I think there's, we've had a bounce off the very worst of things, but maybe we got a second leg of, or let's say a softening of the economy here. So I'm not really, I'd more likely be looking for the crude oil to struggle rather than to go higher.
We'll have more with Victor Adair right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, copper was trading close to $2 a pound in March. Now it's around $3.20, the best it's been in over 2 years. Is this huge rally in copper related to the idea we're all going to be driving electric cars in the not-too-distant future?
I think that it's part of that, Jim. I have to say, I remember trading copper at 50 cents a pound back in the 70s and the 80s. And as recently as, say, 2001, thereabouts, I mean, copper was, a low on copper was was maybe 60 cents, low 60s. The thing that made the difference was China. I mean, you just look at some charts there. We were at, say, a 60-cent low in 2001, and by the time 5 years later, we're trading at $4. I mean, all of a sudden, China was just taking copper like there was no tomorrow, and the price just rocketed. So between 2006, 2008, copper prices were around $4 for a high. The bottom fell out a bit in 2008 when the stock market had that big tumble, but then we had the commodity boom sort of from, let's say, 2009 up to 2011 for sure, and copper went up from about $1.25 to $4.50 a pound. So copper's had some pretty wild swings over the years, that's for sure. In February, March of this year, copper came down hard along with the stock market and then bounced back again. I guess we're up 50% or so in the last 6-7 months. So there's been, during this rally, in addition, to the electric car story, there's been cutbacks in supply. Chile, one of the major sources of supply, virus down there, everybody's done their social distancing interpretations and that sort of thing, cutting back in supply. And I think somewhat similar to lumber that we talked about a while ago, I think some of the producers probably thought, hell, there's going to be no demand, everything's shutting down, so, they were shutting down production. So in that environment, here comes Chinese demand again. They seem to come out of the virus-induced slowdown much faster and much stronger. So they were on the bid again for copper. And certainly we've seen I'm going to call it a dramatic increase in speculative buying of copper on the, let's just say, electric car story. I mean, I think of the idea now, why didn't I think of it some time ago? What a great arbitrage to have been a buyer of copper, on the electric car story and a seller of crude oil. But, I see the trade after the fact rather than, when I should have seen it 6 months ago.
We haven't talked about interest rates for a while. Everybody knows the central banks have told us they're going to keep their rates low for at least the next few years. But bond yields have been creeping higher the past couple of months. What are your thoughts on interest rates?
Yeah, I've been intrigued with that. With the bond yields creeping higher, that is, bond prices falling, the past few months. Not much. I think everybody sort of, when I say everybody, the traders, just kind of assumed that the Fed had been pretty clear. We're going to keep interest rates low. Do we need to repeat that? Guys, don't go out there and short the bond market. But then, the Fed has, I think, backed away a little bit. They had this massive, sort of go big or go home, the strategy that they put into place in March. Bond prices just shot up. Interest rates went down to nothing. But now we got the Fed talking about average inflation targeting, or whatever their term is. In effect, they want to see some inflation at the 2% number or higher, and they're not going to immediately raise rates when it gets there. And I think to myself, maybe, they wouldn't mind seeing the yield on the long bond rise. But and at the same time, by the way, they keep their foot on the short end of the market. So what we've seen, and there's been a great trade here, is a steepening in the yield curve where short rates have stayed at effectively zero, while longer rates have risen. So, the curve has gotten steeper. Bond yields have been rising, so call it the vigilantes, if there are any of them left, may be out there selling bonds, testing the Fed to see if the Fed would come in and buy them. I see a chart here a day or two ago by one of the big New York banks that the Fed now owns something like 22% of all the treasuries that there are. Maybe that's enough, So maybe with all of the massive money printing, as we call it, all of the, how can I say it? Fiscal stimulus is going to be the new QE. Okay, that's a line I stole it from somebody else. Forget who it was, but it's a great line. Government spending, particularly I think under a Biden administration, markets expecting there will be a tsunami of financing. The Treasury printing all kinds of paper, putting it out there, and that ought to put some pressure on interest rates, particularly the long end. So, yeah, I think we might have seen, the low in the bond market, but there's a caveat, and there always is. I think if the stock market gets a case of the jitters, the capital will hop over to the bond market very quickly. So it won't be a one-way street to lower bond prices.
You retired from the brokerage business this summer after more than 40 years. You plan to keep trading your own accounts, and you've set up a new personal website, victoradair.ca. What are you going to be doing with that?
I set up my own personal site because for the past number of years I've had a brokerage site. That's the Polar Futures Group site that my son Drew and I had. It's actually still up there, but at some point it'll get taken down. And my new site, victoradair.ca, will be a place for me to not only post my trading desk notes that I write on a weekly basis, but I will also put up some comment on what I'm calling the trading life. What it's like to actually sit at the trading desk and try to make money trading, the things you go through. Some of the trading principles that I have, sort of the rules, the do's and don'ts that I have. And I kind of put that out there into the world for people to look at, and maybe other people that are out there trading their own money might get some ideas from what I have to say. Not so much, buy this, sell that. That I don't want to get into that business, but comment on, hey, here's an idea. If such and such and such is going on, then maybe the trade is, to do this. And, here's one way to do that trade. Here's another way to do that trade. That sort of thing. So, yeah, and also, as you can imagine, when I was working for a brokerage firm, and I had a wonderful relationship with Pacific International, it's called PI, it used to be Pacific International. I had a wonderful relationship there for years, really liked the guys, but, everything I wrote had to be approved by the compliance department before I write it. Now, in a way, I guess I can say whatever I want on my own personal site, so I don't think it'll be all that racy, but anyway, that's what I plan to do with it.
Victor, I believe you're just like Bob Hoy, who's in his 80s, and Ross Clark. They both retired, but they're still very active and still have a business. Is it something that's in your blood? Once it's in there, you just can't get rid of it?
Well, I've known Bobby Hoy for almost 50 years, and Bob and I have been good friends, and Ross Clark, of course, and I used to work together in the 70s, and we've stayed in touch. I have an 86-year-old uncle who is a world-class academic. He's the guy to talk to if you want to know about the Russian settlements on the west coast of the United States during the period from the 1820s to the late 1840s. And he's 86 years old. He's written about 30 books so far, and he's working on another 2 right now. I mean, retiring from the brokerage business didn't mean I was going to stop working. That's for sure. I love to trade, and I like to talk about trading or write about it. So yeah, I'll keep doing that till I can't do it anymore.
Victor, we really appreciate it. Thank you so much for being on the show.
Thank you kindly for having me. My
guest has been Victor Adair, recently retired from over 45 years in the BC brokerage business. His website, victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.